Hello, it's Guy Costin, founder, CEO of Dakota, and I want to talk about Rainmaker Live. It's a show that we go through everything that we've learned over the course of our lifetime, really, in sales and fundraising, and we share that. Think of it as best ideas, but there's a lot of myths out there that we basically unbundle, if you will. We demystify the things that you should be doing, we all should be doing to get leverage, and that's the theme. The theme is all about leverage. What can a salesperson do to get leverage? And there's a few key points that we're going to go through that are really game-changing. So you don't want to miss it. Please register below. Join us for another Rainmaker Live. You don't want to miss this episode. What is up, everybody? Guy Costin, founder, CEO of Dakota, and I wanted to talk to you about a new Rainmaker podcast, and it's going to be interviewing heads of sales, heads of distribution, asking them all sorts of questions around how they run their sales organization, really digging into their sales processes, how they've set it up, philosophically, how they've literally built the business. So you can hear, as a salesperson, our audience can hear how the best people in the business are running their sales organization. So if you have an interest in being interviewed, or if you want to recommend someone at your company to be on the show, simply email me at guy@dakotalive.com. And if you just want to register on our website where you can sign up to get alerts when we release the newest episodes, simply go to dakota.com and we'll send you emails every time we release a new interview. What is up, everybody? Welcome to episode 16 of the Emerging Manager Growth Show. I'm joined by our president and longtime partner, Dan DiDomenico. Dan, welcome.
Thanks for having me here, Gig.
Yeah, thanks for being here. So, as you all know, this show is all about helping emerging managers do more with less. So there's a lot of myths out there on how to fundraise, what channels you should cover, all these different myths. And our goal is, number one, to demystify a lot of what we're seeing, share with you fund flows, things that have been working over the past month. As you know, we do the show monthly. We'll get into banks and broker-dealers today. And then I'm going to close with some fundraising best ideas and best practices, things that we believe you should be doing that are free, that can have huge impact within your business. So the goal here is to demystify. So Dan, why don't we just kick it off and just start off some key insights? Because as we know, these are emerging managers, typically a single person shop from a sales perspective. They don't have massive resources. They have to do more with less. Let's just give a little insight, because I think a lot of people are super negative on the fundraising environment. We're seeing it very differently.
Yeah, I mean, look, we went through a period of elevated volatility. I think we're getting a lot more clarity right now in the market, which is giving those investment decision makers confidence to make investment decisions, especially in putting capital to work for the longer term. We saw cash build up in 2022, 2023. Elevated rates has supported that decision, but we always talk about that as a temporary placeholder for a potential longer-term investment allocation. Those are exciting times for us.
Right. And as you all know, for those of you who truly do not know who Dakota is, our firm was founded in 2006. We've raised capital over that period of time, last 17 years, about 6 different firms. We raised over $25 billion. And so we're fighting the fight every single day. As you may know, 5 years ago, we launched a database of institutional, intermediary, and retail investors for investment firms to subscribe to. So now we're heavily in the database business. We use it every single day. But the primary thing that you need to take away from this call is we're out there fighting the fight every single day, sharing with you insights. And so the fourth quarter was a tremendous quarter from a fundraising perspective for us, whether it was our mutual funds and separate accounts, both on growth and value, whether it was private credit, whether it was another type of investment that we raised some capital for. Money was in motion. We were getting commitments. We were seeing flows. Do you just want to speak to that a little bit, Dan?
Yeah, and it was nice to see that free up, because there was a period of time there early last year where the clarity to make those types of decisions just wasn't there. There was still just a lot to be determined around rates, around inflation. Now that we're starting to see those pressures ease in the market, we're starting to see the flow through of those investment decisions, especially in the fourth quarter heading into 2024, we're seeing that type of activity pick up. But that meant that we had to be active in the marketplace prior to those decisions being made. We always talk about you have to turn your brain off, try and calm some of the noise in the marketplace. We can't control that, but we know that these decisions move in cycles. And we did know that at some point or another, those investment decisions, those allocation decisions were going to be made. So we're starting to see that type of activity pick up and starting to see flows come through.
So Dan, let's talk about that, because if there's one thing that we've seen with emerging managers, and frankly, anybody starting off, is there's sort of a level of impatience. Yeah. And if you think about the allocations that we won in 2023, I mean, it was years and years of work, especially just even the prior 12 to 18 months. So putting in the time and being patient, but making sure every single day you're getting in front of new investors, booking meetings, doing your meetings, staying consistent.
Building a pipeline. And that's what it comes down to. It's time in the market. It's being persistent and consistent in your effort in the market to build that pipeline. The one thing that I would say to all of our investment partners or portfolio managers is that we always can't influence or affect the timing of a decision. What we can impact is the depth and the diversity of our pipeline. And the more that we have those ongoing conversations in various stages of due diligence going, we know that eventually those RIAs, those multifamily offices, those institutional investors, or the BDs and banks in the home office research groups, we're going to dig into that a little bit later in the segment, they're eventually going to have to be making decisions. That's what they get paid to do. So you just have to be patient in your effort to know that eventually, and we always say that the sales cycle is anywhere between 18 and 36 months, or 9 and 36 months is what we typically would say. But you have to be persistent in your activity and your efforts against those targeted channels where your product is a best fit.
And our process for doing that, we call it city scheduling. So just as a brief segue, one thing from an execution standpoint is our sales team always has, each person has 5 cities on the books that they're scheduling for. And when you pick Boston, you select 9, 11, 1, 3, and 4:30. I had a friend of mine that just went up to Boston to visit his son in college. And he was telling me the story that he set up a meeting just because he was going to be there in Boston with a $500 million RIA, and he was a manager of a commodity strategy. He walks in, the person says, yeah, we do commodities. We're actually doing a search right now. And I said to him, to my friend, I said, we've literally built an entire business around that activity. Hey, I'm going to be in town. We'd love to meet with you, right? It gives you an excuse. So we think it's critical that you use city scheduling to do the execution component of fundraising. And you're always booking meetings.
It forces the issue. There's a clear call to action. I'm going to be in your city. Can you meet on this date at this time? Clear call to action.
Right.
But it also keeps you disciplined to getting back to that city over a defined period of time, because time flies.
Right.
Next thing you know, we're turning the calendar to 2025 and I've only been to Boston once, right? Boston's a key area for us, right? We have it coded in our system to know how often we're going to be in Boston, key metro area for us. So it keeps us disciplined to that schedule.
Our next segment is going to be, we're going to do Steve Aiken on our team, who's going to be join us here at the desk and go through a roundup of family office insights, what's going on, the general characteristics of the family office channel. So with that, we'll welcome Steve onto the show. Hello, everybody. Now we're going to roll into our family office focused segment of the show. So I want to introduce Steve Aiken, who has been with our team for the past 3 years and has really focused heavily on family offices. Steve, welcome to the show.
Yeah, great to be here.
So as you all know, the family office channel, really what we want to unpack here, Dan, with Steve as our resident expert is, what is really going on and what can people expect when calling on the family office channel? What are the dynamics driving investment opportunities? It's very different because if you look at the family office market, right, it's all shades of gray. At least when you look at an RIA or a multifamily office, it's important that you know they're run as businesses. And what I mean by that is, from an investment perspective, they need scale, right? What you get in family offices a lot is direct deals, one-off, more interesting, esoteric. So can you speak to that, Steve, and just give us a little sense for the audience, especially as emerging managers? First off, define the family office channel for us, first and foremost.
Yeah, I mean, it's definitely a different animal, when looking at the family office space versus some of the others. And with the other channels like the RIAs, BD banks, a lot of the info is on the websites. You get some sort of color going into it. Yeah. Family offices, they like to fly under the radar. And that makes our job as investment sales professionals a lot harder and more difficult.
Right.
Especially, like you mentioned, a lot of direct deals, a lot of co-investments. So
Well, I think we just want to just unpack that for a sec, because I think the key takeaway is, and it's really important we make this distinction, RA's multifamily offices are run as businesses, right? And businesses need scale. So if you do large cap growth, and they're going to have a selection for large cap growth, right? It's very expensive and time consuming for an RA or multifamily office to diligence all of these one-off direct investments, whether it's in a building, piece of real estate, an individual company, right? Those are not, we all like to say that, oh, this would be cool to do, but the reality is creating a business like that. But when you look at family offices, that's a lot of stuff they like to do.
Yeah.
So it's not that they're not professional. They're very professional, right? Because they're very wealthy and sophisticated. But the nature of how they go about selecting investments is very different relative to a multifamily office or an RA. Would you like just to speak to that?
Yeah. When you look at the underlying investment program, what's their objective relative to an RA multifamily office? An RA multifamily office, to your point, when you say scale, it's how do you put together an investment program that can be applied to a number of different ultra high net worth, even just individual clients. So it has to serve a lot more in terms of the number of people that would be clients of that RA or multifamily office. The family offices, they can have very specific investment objectives. They got very different time horizons. And I think that speaks directly to the nuance of this space, which we love because it's target rich. You never know what it is that they may be looking for at any given time. And when you make that outreach, if you can show them something that's unique or off the run, those allocations can be significant.
Right. So, but our audience right now, Dan, is trying to figure out, right, where do I spend my time? My time's not fungible. We got to focus, right? Naturally, the reason we like RA multifamily office channel is because it's sophisticated. It's looking for packaged products, meaning mutual funds, separate accounts, private equity funds, private credit, private real estate, right? Where would you spend your time? So if you had to divide, right, and you have the option, family offices versus RA multifamily offices, just to take the largest, how do you think you would spend your time on a percentage basis to try to get the highest probability of wins?
Yeah, I mean, I'm going to be spending my time with the RA's multifamily offices as a higher percentage, call that 75 to 80% of my time, as a complement to those efforts, mixing in some family offices. And again, this gets to the nature of this program. If I'm an emerging manager and I have a strategy that may be short track record or maybe a low level of assets where I can partner with a family office. So again, trying to find maybe an anchor investor where I can be creative in the relationship, either a stake in the GP, either being creative in preferred terms, fees. If I can negotiate for a large amount of assets to make me more relevant in the RA multifamily office space, that's a means to an end that I'm willing to spend some time in the family offices to pursue.
So it sounds like what you're saying, it's more opportunistic.
Correct.
Yeah.
Correct.
Right?
Yeah, it really depends on the product you're looking to raise assets for.
Or individual investment.
Correct.
Right? Because they like to make direct investments.
Yeah,
Big
I
time.
mean, if you
In
have
companies.
that sort of capability, I mean, family office, I would say, would be better worth your time than the RA space.
So let's just take a step back, and I just want to peel back the onion just a little bit so we're really clear with our audience. RA's multifamily offices, which are basically the same, we know they invest in mutual funds in size, separate accounts in size,
Correct.
ETFs in size,
Yep.
to a lesser degree, let's say less than 25%, private equity funds, long locks, if you will, private credit, shorter locks, meaning not 10, 12 years, maybe 5, 6 years, but still sometimes 10, private real estate. So those types of firms are knowns, right? That's kind of what I'm getting at, right? You know that they're investing across those,
Correct.
I call them packaged products,
Yep.
right? Versus highly opportunistic co-investment, direct investment into individual
That's right.
companies, right?
That's right. Yeah, and look, there's some family offices we know that will make that direct investment to the fund, but the true intent is to develop a relationship so they can be fed direct investment ideas.
Right.
So that co-investment, right, where you can offer up that type of capability to be a sourcing partner for them, they love that.
Yeah.
Right.
So, and I'm not saying that family offices in any way, shape, or form don't invest in packaged products. They clearly do. Yeah. What I'm saying is, at the end of the day, there's knowns within the RA channel and multifamily office channel that they all invest in packaged products. We have seen the family office market is just all different shades of gray, much more opportunistic. Yeah. Co-invest is obviously, if you can do it, is a home run, simply because the lack of fees. You're directly invested in that particular company or investment. So as we close out and we just talk about the distinguished, so you were saying, Dan, 75% of your time would be multifamily office RAs, 20 to 25% family offices. And if you have a packaged product, making sure that you're covering those largest RAs. If you have limited resources and time, making sure you're going down, as we always say, to those metro areas, focused on the largest RAs, multifamily offices, building a relationship, right? However, if you're listening to this and you truly are an opportunistic type investment, then family offices can be, much better fit, because you're not going to get that appetite with RAs, multifamily offices as much.
Well, you won't be able to scale in that space. Correct. Yeah. So if you're looking to fundraise for something that's really nuanced, something that's unique in the sense that you're not able to take on that level of capacity or create that level of scale within a certain channel, I would focus more of my time in the family offices then.
Right. Yeah. Right. Steve, any closing thoughts just on the characteristics of the family office channel?
Yeah, I would say be cognizant of how that family made their money. Okay. If they were, a large real estate mogul, don't pitch a real estate product, right? So, you definitely want to come in with a game plan and kind of knowing how they made their money, and then pivot based off of some of the background. But definitely worth spending time, because once you do get your foot in the door at one family office, they spread the word very quickly. So it's those warm leads are always a bonus.
Yeah, they're networked with one another. They share ideas. Yeah. So to your point, you get in with one. That's typically opening the door up to other conversations within the family office market, especially the local family office market.
Right. And I would just say my takeaway has always been it's a very difficult channel to penetrate because of the lack of scalability. It's more, one-offs, onesie-twosies, whereas RA's multifamily office, if you have a packaged product, you can create a lot of scale within that channel.
Correct.
Fair?
Yeah.
All right, Steve. Well, that's a wrap on our family office segment. Steve, thanks for the insights. Dan, thanks for the insights.
Yep, thanks for having me.
Great channel, and we'll see you next time.
All right.
Now, on to the fundraising roundup, banks and BDs. So, Dan, you are absolutely our resident expert on the banks and BDs. And you just want to give us sort of bust the first myth, if you will. And well, first off, give us a sort of the wins, macro, high level.
Yeah.
What are you looking to achieve by interacting with banks and BDs, whether you have a mutual fund, separate account, ETF, or a private fund vehicle?
Yeah, I think some of the more common misconceptions about the space is that I need a massive wholesaling team to be successful in fundraising at these BDs or banks, these bigger platforms. The wins, from our standpoint, is we always look for those points of leverage within these massive systems where you can drive asset flows more from a top down. So they do create select lists, they create recommended lists. And then ultimately, if your strategy ports into models that they're creating from a home office standpoint, that is a massive trend that we're seeing in the marketplace, is more centralization of those investment decisions. So creating models and having the underlying fleets of financial advisors around the country subscribing and investing their client capital into those models. So that's the ultimate win, because that's recurring asset flows. As those models grow, you grow alongside it, being a component of those asset allocation models.
So talk to us about RA multifamily office, parallel track, and how you approach it from a bank and BD, because we've done this for 17 years.
Yeah.
Talk about how you should do both, because on the banks and BDs, it's a defined universe, and you're really betting on the future.
Right. And those are longer term wins, right? Those are longer term sales cycles. So if your key and core prioritized channel is the RAs and multifamily offices, which it should, to help you get to those points of critical mass in assets. Obviously, along the way, you're going to be accumulating a track record. That's really important for these BDs and banks to see. They want to see traction. They want to see momentum in terms of asset flows. And then obviously the longer term track record that you have and be able to show them is going to give them more data, more evidence of how you perform in different market environments. That said, you don't want to wait until you have the assets and the track record. You want to initiate those conversations with the BDs and banks day one. So on parallel tracks.
And why?
Because it takes 3 years of them getting to know you.
Right.
Maybe it's 3 years for you to get to that 3-year track record, if there certainly is.
You want to get on the radar immediately is the bottom line. Yeah. And Dan, let's just demystify size and track record. It really doesn't matter that much to have the initial conversation and get on the radar.
No, because just like RIAs and multifamily offices, they want to differentiate themselves by having options in their menu of investment strategies that look different than other RIAs and multifamily offices. Same thing holds true with BDs and banks. They may not have every single one of the options being more boutique, being more specialized, but they certainly want to have those mixed in because they have a various set of criteria that they're looking for, but they also have a various set of demands from underlying financial advisors they're looking to serve. So they do have options available on their investment platform, their menu of investment strategies that would be more boutique, that would be more specialized, and may carry a shorter track record relative to some of the other more household names that would be available on those platforms.
Talk about how one would approach, because clearly you have the home office due diligence people, then you have underlying teams at some of these banks and broker dealers that you can go through.
Yeah. So, and by no stretch of the imagination are we encouraging you to spend more time calling on individual financial advisors or teams within these systems
before you're approved.
Before you're approved. However, when we go to a given city, this is part of our city scheduling, we have our prioritized anchor meetings to those that would be considered more secondary, more filler meetings. If I'm in an area, we put that in the bucket of rather spend time with a large team within a broker or dealer versus spending time in a Starbucks.
Right.
So it still could be a good, meaningful use of your time to start to generate the demand within that network of financial advisors, whatever that BD and bank may be that you're pursuing, to give them an update on where you stand because they can serve as that voice of support to help you get prioritized in the due diligence process with that central research team. So again, this is another parallel track. We would have conversations going with the central research groups, those due diligence teams, in addition to start pre-marketing to generate the demand and the support for that strategy in anticipation of that approval or hopefully ultimately a recommendation.
Great. So walk us through, Dan, how a bank and broker dealer define an emerging manager.
So it's going to be based off of assets. It's going to be based off a track record, but it's also going to be, they look at the number of strategies that you may have. So an emerging manager in their eyes could be more of a single strategy shop, where again, they believe that they can bring something that's different to their platform relative to their peers and where they're competing. So assets under management, typically we're talking about 500 million and below. They're going to be looking at an emerging manager status within their, and how they would categorize you. Track record, 3 years and less. You're going to get pulled into that emerging manager category within the BDs and banks.
How do consultants basically get involved now? What role do they play within the bank?
Yeah, there's a lot of overlap in the intermediary world to the institutional world. We've seen.
Give us the why, because a bank and broker dealer will hire a consultant.
Correct.
To do, because the Morgan Stanley hires.
Yeah, so a Morgan Stanley, a UBS, even though they themselves might have 20, 25 analysts dedicated internally to support their financial advisors, they're going to complement their research efforts by hiring a Mercer or a Wilshire, again, as a complement, but also as a CYA. They want to have that additional coverage in terms of either write-ups, access to databases, just research notes that their consultant are able to provide them just as an additional check because they're a regulated body. So from a fiduciary standpoint, having that additional support to their own internal research efforts, it makes a lot of sense from a business standpoint. And for consultants,
it's a great leverage point.
It's a great leverage point. They're already doing all the research. Right. They already have the database built out. They already have the notes that they're building out for their institutional clients. So it's a great way for them to monetize the efforts that they're already doing.
So we'll send out the post-call notes from this call, but you have Mercer, Callan, Wilshire, Fiduciant, Goldman Sachs / Rocaton, Siegel Marco, and Conway are kind of the key.
And it's amazing now the consultants are speaking our intermediary language. We had Mercer as one of our interviews at our conference late last year, and you heard David talk about UMA and model delivery.
Right.
Like, those are terms and acronyms that you never would have heard the institutional consultants talking about. Now they have to, because they're serving that end channel and they're looking for solutions that may be deliverable in terms of the investment vehicle, different from how their institutional clients would invest.
So a few wirehouse broker-dealers in terms of who use a consultant would be Merrill Lynch, UBS, Raymond James, Cetera, Stifel, Corio, Wells Fargo, Abbott Downing, and Case. So the consultants, that's why it helps to also be calling on the consultants as well to make sure that they know you.
Correct.
Because then there'll be that cross-pollination.
Correct.
Any key considerations you want to walk through, Dan, just in terms of fees, vehicles, et cetera?
Yeah, and this is where you can be a little creative. We have found success in early days of fundraising, either for a mutual fund, a separate account. Where can you be a partner to that BD or bank? Meaning, what can I provide to them that would be unique or differentiated, especially if it's going to be something exclusive that you can provide to them? And that could be, we're going to provide exclusivity to your strategy via UMA or model delivery for a period of time. And then for that, you're going to enable or activate your separate account or mutual fund. We call it that means to an end, right? So you're going to potentially give up a little bit on the fee side. You're going to give up a little bit maybe on the accessibility to the strategy in that vehicle for a period of time, because you're going to prioritize, say, a Raymond James, who could help put you on the map, raise you some assets, you gain some momentum, and then once that expiration occurs for that exclusivity, and that's going to open up the other channels for you then to fundraise. Fees are always a concession too, if you want to negotiate with those key platforms, either for dual contract SMA, single contract SMA, or UMA. Those are always ways that you can get their attention, is to provide preferred fees for their underlying financial advisors. They love to be able to tell those types of stories. Vehicle accessibility. We talk a lot about UMA. If your strategy is able to port into that type of a format, we would encourage you to do it. I mean, we are seeing just across the board with these BDs and banks, more of an appetite, demand, and certainly flows going into these UMA programs.
Yeah.
Obviously, fees are an issue, or not an issue, but they're a point of consideration. But if you have the ability to scale, it's a great way for you to entrench yourself into that system and grow by offering up your strategy in UMA.
Great. So Dan, any closing comments as we wrap on the banks and broker-dealers as a legitimate channel for emerging managers?
Yeah, no, I mean, like we had mentioned, it's not only your efforts in going direct to the research groups in seeking that approval and ultimately a recommended status. I would encourage you to think about looking at those larger teams, especially within your travels, right? So if it's Morgan Stanley, it's looking at those Greystone teams or PWM teams. I mean, they're all very well identified in our marketplace. So as a secondary channel within the BDs and banks, we call it the second sale. I would make that part of your marketing focus.
So this does take time. You do have to be patient in terms of anticipating results, getting out and doing those meetings, just consistently applying it, because banks and BDs are always looking, just like ours in multifamily offices, for great ideas, great new investment ideas. We're the supplier of that. An emerging manager is a supplier of that. You don't know who's going to like you. You got to cover them all. Luckily, in our database in Dakota Marketplace, we have all the banks and BDs with all the appropriate contact people to reach out to. So it's all there. And well, Dan, thanks so much for covering the banks and BDs so thoroughly.
Of course.
Now we're going to kick into the conferences. So we really strongly recommend a lot of these conferences. They can be very beneficial for making contacts, whether you attend, pay to attend, or you kind of just show up, because we know budgets can be tight. But here are upcoming conferences. We'll send this out as a follow-up. But as you can see, there's about 7 right here that are upcoming that we believe we've handpicked these for you, that we believe are very valuable.
Yep.
With that, we'll kick into fundraising best ideas to close. So we're going to go through 3 things. It's the leverage of a CRM, alignment, and asking the two tough questions. So one thing, Dan, that we're such ardent believers in is the use of a CRM. And there's a couple of reasons. All you have to do within a CRM is get your meetings that you've scheduled into the CRM so you can run past activity reports. Any meetings you schedule, go into your CRM, then you can run past activity reports. The reason that's so important is it will then allow you to trigger sales actions by looking at your past activity. We do it all the time. It's incredibly efficient. It's a click of a button. Yep. Dan, just think about how we wouldn't be able to exist if we didn't have the access to a CRM with all of our past meetings and meeting notes.
Correct. Yeah, it's such a powerful tool that way because you're able to use it, as Guy said, to create those sales triggers. So if you're looking at where have I been, what were the notes, what was the follow-up, right? So easily, especially as you're on to that next trip, right. Things can fall through the cracks unless you are capturing everything that you learn. And that's the only way to stay productive. And to make those prior trips, we're all spending money to travel. To make that more meaningful, you have to get the information into your CRM.
And as we always say, if you're an individual salesperson, you need to think of yourself as Dan DiDomenico Inc., Guy Costin Inc., and treat yourself like a business. All the best businesses leverage technology, in this case a CRM, to make your time much more efficient. The second big category of a CRM, by getting that information in, is you can create opportunities, which translates into pipeline reports. And those pipeline reports also trigger sales actions and also allow you to very quickly manage up to show your boss or the higher ups, the CEO, of where you stand against particular channels and opportunities.
Yeah, so it's going to help you identify areas where you've maybe not have been penetrated, right? So the penetration rate against your addressable universe that you created, so the TAM. So that's our account sales cycle screen or field that we fill in to be sure that we are showing progress against those targeted accounts. And that feeds directly then into an opportunity pipeline.
So we believe that the power of a CRM, it can take a salesperson from 1x to 2x to 5x to 10x. It's the only way we've been able to see a salesperson who only has their time to sell, if you will, that can 10x their productivity. So we strongly recommend, we have all sorts of content that we've created on how to implement a CRM, whether it's Salesforce or others. So huge leverage point. Now, that takes us into the next concept, Dan. We talk about this all the time. There's complete misalignment between where a salesperson believes the amount of money they should raise and what the senior people at an investment firm believe. It's really important, number one, to create alignment via a sales plan. Mm-hmm. The sales plan really doesn't have to do with the sales plan per se. It's sitting down with your higher up, your boss, and agreeing to what good looks like. That's the key. And then agreeing to a cadence of describing and going through what you've accomplished during that week or the prior 2 weeks. I wouldn't go more than 2 weeks. We like once a week. It can be a 15-minute check-in. Yep. Here's the pipeline report. Here's activity. Here's the feedback that I'm hearing in the marketplace. Anything you want to discuss on
You're
alignment?
setting expectations, and then you're providing the update against those expectations.
Right.
You don't want surprises, right? Because we always talk about internally, absent of reporting, absent of showing that type of progress, absent of providing feedback, the normal assumption is that nothing's being done.
Right.
So you have to put those mechanisms in place, but most importantly, as Guy was pointing out, it's creating that alignment up front, establishing what are the proper expectations, getting agreement on that.
Critical.
And then being able to provide, how am I going to get there? So what's that roadmap? What's that sales plan look like? And then progress against it.
Great.
Reporting.
So I can't tell you how strongly we live it every single day because we report to our 6 clients every single week. Yep. We do check-ins every single week. So we're all in the loop and no one's left out in the dark, if you will. So now the greatest outside of a CRM and alignment, right? Those are 2 huge leverage points. Asking the 2 tough questions. Now, we're not going to go through, we have a Rainmaker program that we do once a month that goes through this in detail. We're just going to highlight, because this is where can I get leverage? You can get leverage from a CRM, you can get leverage from a sales plan and alignment, and then you can get leverage by asking these 2 tough questions. What I mean by that is you do a meeting, right? You spend all this time to get to Cincinnati, you do your meeting, right? And people would say to me, Guy, what is the follow-up cadence after the meeting? And I said, there is no follow-up cadence after the meeting. The follow-up cadence is in the meeting. And here's what I mean. If you're marketing a long-only strategy, you finish the meeting, it's over, you look over at Dan, you say, Dan, really enjoyed our time today. Could I ask you a quick question? Sure, what's that? Do you see our strategy fitting within your asset allocation models? If they say yes, okay, you know what the follow-up is. If they say no, you put them on the mailing list. If they say yes, then you ask the next second tough question, which is, oh, that's great. You think our large cap growth strategy would fit within your asset allocation models. Do you anticipate doing a search in the next 12 months? If they say no, you know what the follow-up is. Just by asking those two simple questions, you've taken all the mystery out of where you stand, and you very rarely get sort of the innocuous or the fuzzy answer. It's very, very clear. If you're marketing a private fund, same question, do you see our strategy fitting within your asset allocation model? If they say no, you know what the follow-up is. If they say yes, then you simply say, we have a final close on 3/31/24. Would you be able to make that final close? If they say no, you know what the follow-up is. If they say yes, you know exactly what needs to be done, because now there's some real tactical things, meeting with different constituents within the firm, what have you. So we hear so often when people say, hey, how was the meeting? Oh, great meeting, right? But they never ask the two tough questions to get a sense of where they stand. And I know for a fact 99.9% of salespeople don't do this, because I ask allocators every single time and they say, no one asked me these questions. This will save you so much time and guesswork. So ask the two tough questions. So leverage points are CRM, alignment, and asking those two tough questions to close out a meeting. So with that, and as we wrap, Dan, I can't thank you enough for your insights into the banks and BDs.
Thanks for having me here. It's
great having you here. We'll follow up with all the documents, and our next show, the EMG show 17, will be Tuesday, February 13th at 1 o'clock. Thanks so much for joining, and have a great day.
Thanks, everyone.
Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace, so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.